Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for a Monday market update, 9 a.m. every Monday morning. Get you ready for the week. Stocks to watch, economic news you need to see, and what a week. Just last week, I was worried the bull market was getting a little tired. Then Chair Powell and the Fed came out with their set of jumper cables to recharge stocks, and we're approaching all-time highs. Shares of GameStop jumped nearly 12% on the week, but are investors buying into a corpse of a company? I'll explain why the old GameStop is dead, and if the new one can survive in today's main topic. Stick around after that. We'll go through our Monday market update, all the stocks you need to see this week, and the economic trends to follow. Before that, and just in time for the holidays, you can now gift bonds on the Worthy platform. Give the gift of 7% cash flow this holiday season. With that yield on the Series I savings bond falling to just 5.25% this year, I had to find somewhere else to invest my cash. Money market funds are okay at 5%, but are likely falling soon with those interest rates. Fortunately, that's when I found Worthy and now earn 7% on my extra cash. It takes less than 5 minutes to create an account, connect your bank, and all you need is an email address to gift someone a bond for the holidays. Worthy bonds are backed by short-term residential real estate, the safest part of the real estate market right now. You'll earn interest compounded daily and can withdraw your bonds or interest anytime with no penalties or fees. Look for the link I'll leave in the description below. Check out this exclusive offer I negotiated for all you out there in the Bowtie Nation. Buy 5 bonds and get 1 free. It's like a 20% return on top of that 7% interest rate. Back to our main topic though, and I know this is something a lot of investors out there are not going to want to listen to, but GameStop the retailer is dead. GameStop the investment company is all that is left, but there could still be some upside potential in this and ways to play the stock. For those of you following GameStop, I wanted to detail how management killed the retail business just last month, why this is going to be a totally different company going forward, and how to invest. If you didn't see that news, the board of directors put the final nail in the coffin to GameStop's retail business just last month when it announced its third quarter results. During the quarter, the company reported revenue fell 9% from the year-ago period and is down 6% so far just this year. Now, management has had some success in cutting costs, increasing the gross margin to 26%, and then cutting some of those operational expenses by 23%, which did lead to a less of a loss of $3.1 million for the quarter, a huge improvement. But the company still has lost over $56 million just so far this year. And looking out at this business over the longer term, revenue has now fallen in 6 of the last 8 years, and the company has not made a profit since 2018. The gross margin profitability after paying its suppliers is now at a 5-year average, so any further improvement in income increases is going to be more difficult just on the back of those profitability measures. Other cost cutting is also running out here. The amount spent on those operational expenses, so selling, general, administrative, is now at 28% of sales, which is also at that 5-year average. Now, GameStop had managed to cut its expenses to just 23% of sales back a few years ago, but going forward, it is going to take much deeper cuts to eke out any more profitability from this, and that's going to come at the expense of sales growth or sink the company even further into decreasing sales. So it's kind of a no-win situation. It can cut costs even more, but it's going to have a very hard time growing that retail business if it does, and it's just going to lose more and more revenue each year. In short, this is a company that may never be profitable. And where this all comes to a head is in its cash flow. That income statement can show a fudged picture of finances because it's all those accounting tricks, but it is the actual cash flow in and out of a company that shows its true survivability. And here, the picture is not good. So far this year, GameStop has bled $192 million from its core operating activities and has spent another $54 million reinvesting for growth. Since the company doesn't owe much debt, financing cash flow really hasn't been too bad here, with just an outflow of just $8 million. But all this adds up, and GameStop hemorrhaged over $266 million in cash just in the first 9 months of this year. Now, like its net income loss, that is an improvement over last year's cash outflow of almost $500 million, but still over $250,000 of cash. Now, that is a problem, but if it weren't for what I'm going to talk about now, it would be survivable because the company still has $929 million in balance sheet cash reserves. It's cash set aside to handle this cash loss, until the board of directors made a decision last month. That big news was that the board approved 2 changes, detailing them in its 10-Q report. And I was really surprised it didn't have a press conference for these. This is something you definitely want to announce in a press conference. I think the board is just trying to maybe put some success behind the changes first before it really comes out public with it. But first, that it would now be investing balance sheet cash into stocks and other investments. This is a giant change because traditionally those cash reserves are held for business needs. Folks, understand companies are miserly strict about what they do with this balance sheet cash because it needs to be there for operations when they need it. And this isn't money just sitting around, but cash the company is counting on to pay for those operational expenses, strategic investments when they come up, and just other cash flow needs like the $266 million in cash that the company burned through over the last year. That's why it's almost always exclusively invested in treasuries, money market funds, or just short-term, very high-quality corporate bonds that have almost no risk of default. Okay, to now say that this cash is going to be used to invest in stocks, which could lose value very quickly or just be locked up to make that return, it's kind of like a blasphemy for most chief financial officers. Even more surprising, though, it seems that the board is giving CEO Ryan Cohen the checkbook and full control of this investing. The 10Q gives him authority and reads, with such assistance and committees, he may engage, but critically does not say that he has to consult anyone on this. Now, this is where investor perspective is going to differ on whether to invest in shares of GameStop after these changes. To be honest, I gotta agree with Wedbush analyst Michael Proctor in calling this kind of an inane and alarming move for investors, because to potentially not have that cash available for the company when it is burning through $300 million a year, unless Cohen can turn these into fast profits, basically turns GameStop into a hedge fund. Now, if your view is that Cohen can invest this cash for outsized returns, then maybe it's still a good bet. With sales expected further down by 5% next year and GAAP losses of at least $20 million, he's going to have to make a very solid return on a few $100 million that he can safely invest. Now, Cohen did co-found pet retailer Chewy in 2011 to become a billionaire when it was issued shares in 2019. He made his first investment in GameStop in 2020 and has become an activist investor, buying large chunks of companies to force a management change. For example, he started accumulating shares of Bed Bath & Beyond in March of last year, but then selling out in August before the company went bankrupt. He also built a big stake in retailer Nordstrom, but there's really nothing here in his track record of returns that gives me any kind of confidence that he can manage GameStop's investments. Now, with most hedge funds typically charging a 2 and 20 fee structure, so 2% fee and 20% of the profits, then maybe GameStop as a Cohen-led hedge fund isn't a bad deal. You're basically getting a hedge fund returns without the oversized fees that they usually charge. If he can produce those outsized returns on that cash to plug that operational hole, then maybe it could surprise investors to the upside. As the shares have been able to do over the last 2 years, though, it is very risky on this. Now, I want to look at some of the stocks I'm following this week. First, we got FedEx Corporation is going to be reporting its earnings on Tuesday, with shares up 64% already over the last year against revenue that really is expected flat over the period. Cost cutting is expected to drive a 22% improvement in earnings, so about $18.24 a share on the year, but shares are still trading relatively expensive here at 15.4 times on that price to earnings basis. That is well over the historical average. We can see here in the statistics the averages for those price multiples here. We see trailing PE. Right now, trailing PE 17 times. You can see that is very well over even this 13 times PE here it was at last year, so relatively expensive. It seems the market is fully pricing in kind of a soft landing for the economy here, folks. While November retail sales reported Friday were higher than expected, the stock is fairly priced at best, and I think with limited upside potential. Now, I'd probably avoid the stock at this point, but Tuesday's report is still going to be important for what management sees in consumer strength going forward. Also going to be watching Carnival Corporation, ticker CCL. It's scheduled to report its earnings Thursday after a strong rebound, and shares up 120% over the last year. Sales are expected to continue at that double-digit growth as the company gets back from the pandemic, and the company is expected to reach positive earnings next year. Now, the recent run may be stretched a little bit, but longer term, I think cruise stocks should do well as that baby boomers spend through the massive wealth accumulation that I talked about in the last week's video. Disappointing millennials waiting on that great wealth transfer lie. Also going to be watching Rivian Automotive, ticker RIVN. It shot up 20% last week after signing an agreement to supply AT&T with its fleet of EV trucks. Now, previously, it had been pretty much an exclusive supplier to Amazon's trucks. Diversifying that, it's a big deal because it helps diversify the company's revenue as kind of a one-act supplier for Amazon. Rivian is one of my favorite EV stocks with upside potential, especially on those recent delays from these other automakers like Ford delaying its F-150 Lightning plans. That's going to give Rivian the opportunity it needs to take market share in that truck segment of EVs. Also watching ChargePoint Holdings, ticker CHPT, up more than 50% just over the last month from its lows, up big last week on the rise in growth stocks and other EV stocks. Watching ChargePoint here, we are going to see a lot of the funds from that IRA, from that Inflation Reduction Production Act going into charging infrastructure that's going to be hit across the U.S. We're going to start seeing a lot of those plans released in January. I think it's going to be a big move for investor sentiment in this stock. We've already seen a couple of those charging stations roll out there in Ohio, there in New York. I think a lot of these, we also heard that Starbucks is using ChargePoint for its recharging station. So I can only imagine if every Starbucks has a ChargePoint refueling or charging station at one of its places. I think this is going to be a big hit to investor sentiment on the upside as these deals start getting announced here in January of 2024. Showing you the big picture here with the sectorspiders.com, the sector tracker here. Great free resource, show you how the sectors of the economy did and the stocks within those. We see last week all 11 stock sectors did close higher last week with really surprising pockets of strength and weakness here. We saw real estate stocks surge higher on the promise of lower interest rates over the next year that would support property prices. It's a theme that I've been highlighting over the past few months, and REITs are now up 11% just in the last month. Okay, we are going to see this unfold even more out into 2024. I'm about to release my How to Invest in 2024, that big plan for next year. It's going to be a big part of that is going to be investing in real estate stocks, in REITs. I think we were surprised at how hard REITs and real estate property values got hit in those rising rates. I think we're just going to be just as surprised when those rates start coming down and what it's going to do for these real estate stocks. We also saw financials, especially the banks, also did very well as investors rushed back into some of those hardest hit stocks in that interest rate theme. We also saw consumer discretionary stocks do really well, continued higher on surprisingly strong November retail sales data, as well as just a general upswing in the market. Year to date, the sector is up 39%. We can just zoom out here to the year to date, see how those consumer discretionary stocks, the retailers have done, up 39% on strong consumer spending. But I got to wonder how much further there is in these consumer stocks. If we look here on FactSet Data Earnings Insight, it shows stocks in the consumer discretionary sector trading at a price of 25.4 times earnings that are expected over the next 12 months. That is more than 10% over that long run average PE ratio. So you see the dark blue bar is the current PE ratio for the stocks in this sector. Green is that 10-year long-term average. It's not the highest priced stock in the market. That would be tech stocks here on the left, but it is worrisome for if we're considering that consumer spending is going to be slowing down. We do see that 41 out of the 53 stocks in the consumer discretionary sector are trading in the green with some huge returns so far this year. 147% for Royal Caribbean, 130% for Carnival. So you've got the Carnivals there. You've got Tesla with its 105% return. Amazon here, 78%. Bookings, Holdings, Airbnb up, Expedia, so a lot of those internet names as well, those cruise lines. And folks, I gotta wonder at this strength, while we may avoid a recession, there is no doubt the job market is cooling. Consumers are pulling back on their spending. It doesn't mean that all consumer stocks are set for underperformance, but it should make you think a little bit harder about the ones in your portfolio. That said, the market is still looking very good here, folks. All three major indexes closed significantly higher last week, while the Dow is reaching new all-time highs. Stocks in the broader market, the S&P 500 here, are now just 2% from that 2022 all-time high, and it's looking very probable we're going to see it again soon. The Fed's dovish statement last Wednesday seemed to take any remaining rate hikes off the table, and the market is now pricing in a rate cut as early as March, with 6 total cuts next year. Here we see on the CME FedWatch rate tool a market-based expectations of what the market is expecting the Fed to do in its next meetings. We can see here 89.7% chance that the Fed continues to stay on hold here in its January 31st meeting, 525 to 550 basis points, about 5.25 to 5.5%. And you can see the market now expects the Fed to start cutting as early as March of next year and to cut 1, 2, 3, 4, 5, 6 times, up to 6 times of rate cuts next year. And to understand what that could do with stocks, all you need to do is look at what the opposite did. Rising rates did to stocks over the 2021 and 2022 period. A drop in interest rates, and even just leading up to that drop in rates, as we saw last week, as we've seen over the past couple of months, that anticipation of falling rates is going to support higher stock prices, and especially those hardest hit. I'm going to be watching here in 2024, that real estate stocks, utilities, and some of those growth stocks like EV makers. Give the gift of 7% cash flow when you gift bonds on Worthy, and don't forget to get your free bond with the link below. Or click on the video to the right for the 12 dividend stocks that will pay you every single week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.